Hello and a warm welcome to Econoday Unplugged on Tuesday, the 4th of May 2021. Mark Penders stateside and I'm Jeremy Hawkins in London. Well, as far as the economic go, last week was a case of compare and contrast. So while the US economy was busy expanding at a 6.4% annualized rate in the first quarter, its Eurozone counterpart was sliding into a second double-dip recession. An accelerating vaccine rollout may mean that historical GDP reports are currently not as important as they might normally have been, but the ominously wide performance gap should still be some kind of a wake-up call for European fiscal policymakers. So it's particularly good to see that the inoculation rate in Europe has picked up significantly. Rather more up to date amongst this week's data and events. On Friday, we'll get a new US employment report that could raise further question marks about the appropriateness of Fed policy. And the day before, we'll get Scottish Parliament elections, which, while normally not exactly a blinking light on investors' radars, this time could have a significant implication as far as sterling's concerned. On the central bank front, the RBA earlier on today signalled no change in policy, but following the Bank of Canada's decision to reduce its quantitative asset purchases late last month, more general tapering speculation could get a limited boost from the Bank of England MPC meeting also on Thursday. So, Mark, let's kick off with your side first.
Okay.
Seems nothing particularly new out of FOMC and Mr. Powell last week, but might they be forced to change their tune a bit on Friday?
Oh, if we get another significant, they still have they have a couple of. It would take more than just one more million range non-farm payroll jump. Right now, the consensus is 903. Canada's consensus for April non-farm employment growth is 938,000. That would compare with 916,000 in March. These are 5 times the normal size.
How far, if that's right, let's assume that's right, how far below the employment levels we had back before the start of the pandemic would we be?
That's a good, well, we're still roughly 8 million. So that's one, so you're going to need another 8 months basically at that pace, you're right. But so that's what gives them, that's, the need to help the labor markets, especially at the service sector end, is paramount to them, and they'll do that as long as inflation doesn't shoot out and go runaway. Then that's what they're going to do. So and the unemployment rate's predicted to come down to 5.8%. That would be 2 ticks lower, but it has been disgraced, the unemployment rate again and again, including last week when Jerome Powell. It's almost a senseless measure, I guess. But in any case, the participation rate now is giving a little bit more of a oomph, and it's predicted to come up 1/10 to 61.6, which is still comparatively low. And so until that gets up, that would be. So that's what we're looking at on Friday. We just had vehicle sales. Interestingly enough, they just came out, and these are annual rates, and they're at 8.5 million annual rate. That's I have my tables here. Let me just tell you what that is. That is a very significant. It's way beyond Econodays consensus range, and this offers the earliest indication, hard indication of retail sales in April, and this will definitely point to spillover effect from the federal stimulus checks that trickled into April, started in March, moved into April. That's the farthest I can see in my graph, which is the last dozen years or so. So that is a very, very strong rate, and that points to yet another. I mean, remember the March retail sales report jumped almost 10%, and that's on the month. And these are adjusted numbers. So it makes up for shopping days differences, but. So you're looking at another significant. That's a very, very strong. So some of these are business sales mixed in today's unit sales report, but still, that's a very, very strong number. It took our forecasters by surprise, and that, by the way, lifts. Well, it's still minus 13. The Econoday Consensus Divergence Index for the U.S. It had been in most of the year. It's been in significant plus territory, but They've. It looks like the forecasters are finally getting ahead. It
Getting the hang of it. Strong numbers, Tom. Yeah.
Yeah. Now they're overestimating. Well, the ISM came in at 60 or at 60 and change, and that was below the low estimates because that report for the last two reports had exceeded everyone's estimates, so they got way ahead of it. And the report at April of 60 is like the perfect report. That's a beautiful number, 60. But that brought down this index because it was way lower than the super accelerated rate that our forecasters were calling for.
Mm. So how much do you think, in terms of this fiscal stimulus, how much do you think that is sort of worth in terms of, sort of the shape of GDP, let's say in the first half of the year, and will it then necessarily start to slow down in the second half?
Boy, that's an interesting question. I guess we're too near it. It's like a liftoff. We're just too near it to really know the quantity of energy it's going to have. But right now, at the beginning, it's very, very strong. So, GDP came out for the first quarter for the U.S. And like you said, the U.S. is doing pretty well. And the consumption expenditures were, represented. Actually, how much of that? They were at a 10.7 rate, and that was I don't have that point contribution handy, but that's a big significant piece of that 6.4% overall rate. And and that's the stimulus payments. And if they're going to go on, and in one of the conference board's reports, they were talking about expectation. They interviewed consumers and some of their data. They were talking about consumer expectations for more federal stimulus. So they don't see it because they don't see it stopping. So this will go out and spend. I know, I don't know what I'm going to get, but go out for a night's dinner. I don't know once I get my vaccine. So I don't know. Anyway, how's retail sales in the UK doing?
Well, over in the UK, things are doing, I suppose we've got to say, not perhaps quite buzzing along at the same sort of rate as we have in the States at the moment, but it's certainly the case that the UK, and indeed to some extent Europe as well, is finally starting to pick up. So I think expectations by and large now for the UK economy in the second half are extremely strong. The last set of retail sales we had, what for March, and they're up 5.4%. And again, that's seasonally adjusted, just a month-on-month rate. And that was having grown at over 2% in February time. So the retail sector as a whole now is starting to come back with something of a bang.
And you said in you did a merchandise trade report, you were saying, talking about a diminishing effect, almost optimistic, but you were saying like February exports are down something like, don't quote me, something like 12% or something, and you're saying that's a good number. I mean, so where does the Brexit effect sit?
This is the Brexit effect. I mean, what we're seeing at the moment is effectively the January. Well, okay, let's just back up a little bit. We've got to say that for the first quarter, it's going to be particularly difficult to disentangle the effects of COVID from those of Brexit. But what we can do is look at what's happening to exports going to the EU versus exports going to non-EU countries, and indeed for the EU itself, looking at their exports to the UK versus exports elsewhere. Now, during the January period, we saw UK exports to the EU literally going down the proverbial plug hole. I mean, they were down more than 50%. Now, as of February, that decline had been reduced to 17% or so. Now, that's a bad number, full stop. However, it's nothing like as bad clearly as it was in January time. So I think, the broader picture from what we could see from Brexit at the moment, if you sort of stand back a bit, is that, yes, it's still negatively impacting UK flows going into the European Union and EU flows going into the UK. But there are at least some tentative signs that, firms and indeed governments are getting more used to how they should export and import within the new trading relationship. So all being well, perhaps we'll see those negative numbers, rather less negative once we get the March data coming out. So, I mean, it's moving in the right direction, but, the bottom line is still that Brexit is hurting the UK economy and the European economy at the moment.
But if this were a race, who would you take right now to lead the GDP for the year? I mean, anybody in Europe? Maybe not. China's always in there. The U.S. How about the U.K.? I mean, after this year is said and done,
I don't think we'll match the US figures, but yes, I do think the way the UK is starting to shape up now, It's going to be really interesting to see what happens, particularly in the second quarter and as we get into the second half of this year. Now, first quarter, as ever, the UK numbers are relatively slow compared to your side, so we don't know what the first quarter looked like yet, but it still looks pretty well certain it's going to be a negative number, as indeed we saw coming out of the Eurozone. However, because we've now started to reduce and ease some of the COVID restrictions, and there's more of that coming as we go through this month. And in theory, once we get to the second half of June, all the social contact restrictions should completely go out the window. And from the the kind of the high frequency data you get from foot traffic and things like that, it looks as if the consumer is going to come back with a bang. I mean, savings ratios right across Europe, and indeed, presume your side as well now, are through the roof because a lot of these support payments haven't actually not been spent. So there's an expectation that once the consumer can actually go out and spend, that they're going to do precisely that. So I think particularly for the UK, because we're so much further ahead in the vaccination rollout compared to our Eurozone counterparts, the UK will certainly be leading the way. And that's one reason, I suppose, well, it takes us, nice little segue, takes us into the Bank of England meeting this week. If we go back, well, certainly a month, let's say, ago, I think expectations for the upcoming MPC meeting would have been, well, they're not going to do anything. There's no point in them doing anything. We've got a negative first quarter, don't know anything really about the second quarter, so why would they do anything? But now I think there's growing speculation that we may see, I've got to say it's kind of a soft tapering, if you like. It's not going to be a big tapering if we do see anything. But what we got at a stage now whereby I think people are starting to realise that the UK economy is outperforming. To quote the UK, the Economic Consensus Divergence Index, we're right up at 41 now, and that's the highest the UK's had in a long time. And I think, it's a reflection of the fact that economic activity has responded very quickly to the relaxation of the COVID restrictions. So the Bank of England, I mean, in theory, they're operating with this ceiling on quantitative easing of £895 billion sterling. But that was supposed to see them through the balance of this year. So it wasn't due to end until December 2021. However, from what's been a pretty constant buying rate over the last month or so, just short of £4.5 billion sterling of the weekly asset purchases, they're going to hit that ceiling round about second week or so of September. Now that gives them two choices. If they want to keep, continuing QE, either they're going to have to raise the ceiling, and that seems pretty unlikely given what we said earlier about the state of the UK economy. And indeed, when we get the monetary policy report, the bank's updated economic forecast, they're almost certainly going to be revised significantly higher. These will be out on Thursday, the same day as we get the Bank of England announcement itself. So it seems as if what they can do, they are going to increase the ceiling, which is extremely unlikely.
When is that ceiling going to up? You said September?
Well, the ceiling will be reached at the current buying pace round about the second week of September. So assuming they're going to stick with that ceiling, it either means they're going to have to pull the termination period forward to September, or they're simply going to reduce the actual size of asset purchases at the moment.
Well, they have 8 meetings a year? The BoE?
That's 8 meetings a year, yeah.
So do they have to talk about it this meeting? Can they just wait till the next meeting?
They don't have to, but I think I think September it's not actually that far away, and I think because in theory, as it stands at the moment, once we get to September and they reach the 895 billion ceiling, that ostensibly is the end of quantitative easing. It's not like, for example, the European Central Bank or the Fed, which have got these indeterminate periods. We'll keep on buying until whatever. As far as the Bank of England's concerned, we're increasing quantitative easing to 895 billion. To see us through until the end of the year. So
they might regret that. I mean,
I think to be honest, what their view is going to be, well, look, in actual fact, the economy is outperforming what we're expecting, not just the markets, but it's been significantly better the BoE's expectations as well. So what they can simply do is to reduce the size of their weekly purchase, let's say by $1 billion or so, and by doing that, they can extend the process through to the end of the year. So it's kind of a pseudo tapering. They will be tapering purchases, but it simply allow them then to stick with their year-end, finish to quantitative easing.
Tell us the mechanics of their meeting. Do they take questions? Do they have to answer this?
Well, they will. Well, I suspect if they're going to do this, they're going to make some reference to it when we actually get the policy announcement alongside the actual decision. That's midday at London time on Thursday. And then, yes, normally the Bank of England governor will be taking questions after that, and it's a question then of whether they want to come out and actually say, well, look, we're going to be doing this per week, which seems unlikely because they've never really done that. More likely, I think they'll do what the ECB did, but the opposite. So whereas the ECB came out a month or so ago and said, we'll be stepping up purchases because we're worried about what's happening in the bond market, the Bank of England is probably going to say, we're going to start tapering our purchases, to ensure we remain on track to hit our target by year end and to reflect the fact the economy is doing that much better now.
So then sterling would jump on this?
I think, well, it may go up a little bit. I think, it's to the extent it's about as mild a tapering as you can get, because the bottom line is, come the end of this year, we will still be at 895 billion quantitative easing. So, nothing's really changed from that angle. It's just how we get there. But you've got to think, the way financial markets work is as soon as you get any change to policy, even if it's small, speculators start jumping up and down and say, aha, right, well, this is the first change in the direction of eventual tightening.
And people also have to bail out of positions that are leaning the wrong way too.
Yeah, could well be. Now, that said, of course, probably what's going to be more the major factor for sterling this week is what happens to these Scottish elections. So I kind of mentioned them in the intro, and let's be honest, normally the idea of Scottish parliamentary elections is not the be-all and end-all for investors. However, this time it is a little bit different, and it's really different due to good old Brexit again. Now, the Scots, when we had the EU referendum, going back, 2016 now, the Scotland as a whole voted very clear signal that it wanted to remain part of the European Union. Now, it wasn't able to remain part of the EU because the UK as a whole voted to come out. So ever since then, the Scottish National Party has been pushing like mad to have a second referendum, which effectively would allow them independence from the rest of the UK, with a view to rejoining the European Union, even though they're out at the moment, as a single, sovereign state. Now, can that happen or not? Well, the first thing is on Thursday, we're going to get these parliamentary elections. If there is a big majority for the pro-independence parties, and the key here is the Scottish National Party, which is currently forms the government at the moment. If there's a big pro-majority, they're going to ask Westminster to allow a second referendum. And this is when it starts getting murky, because the general assumption has been within the kind of legal literature is that Scotland can't hold an independence referendum unless Westminster gives it the nod. Now, looking at some of the legal jargon, it's not actually clear whether that is strictly speaking the case. So it may be possible that the Scottish government could find some route whereby they could hold this referendum without having to get the go-ahead from Westminster. However, even putting that on one side, the Westminster view for a long time after the last referendum, in fact, Boris Johnson's come out and said, well, that is a once in a lifetime referendum. We're not going to have another one for another 30, 40 years, whatever it may be. However, he seems over the last, let's say month or so to have conceded the fact that, well, if there's a huge majority in Thursday's elections in favour.
Well, what are the odds of a huge majority?
I'll tell you what, it's hard in terms of the way the polls are going at the moment. And I must say, they've been swinging about all over the place due to some of the local politics going on in Scotland at the moment. All the polls seem to indicate that Nicola Sturgeon, who's effectively the Prime Minister, the First Minister of Scotland, and her Scottish National Party will win it comfortably. What isn't clear at the moment, because it literally depends which poll you pick, as to whether or not she's going to get a big majority, or perhaps even not a majority, she'll have to have another coalition government. So I think in terms of the way the markets are going to react, there is certainly potential for some real volatility here. When we go back to 2014, and we had the first independence referendum in Scotland, that was won quite easily by the anti-independence bloc. But at the time, the polls, which were looking for an easy win for the anti-independence bloc, had narrowed substantially. And when the results actually came in, the anti-independence group won by 10 percentage points or so. And sterling actually rallied quite significantly on the back of that as a relief trade. So I think, looking forward to this one, if we were to see the S&P perform badly, that effectively would just kill off the idea of what they're calling this Indy Ref 2, the second referendum. And the pound, I think, could certainly have some upside potential, like just 2 relief trades. However, if we were to see the S&P win by a huge majority, and it is politics, so who knows what's going to happen, the initial reaction there is going to be negative. And there's going to be a lot of people scratching their heads about, right, okay, can Westminster actually stop the referendum, even if they want to? And if there's going to be a referendum, when's it going to be held? I mean, originally the SNP have been pushing for a referendum this year, but due to COVID now, it looks like they've shifted their timetable into next year at the earliest. But, we could end up with being in this kind of Brexit-style trading pattern whereby you go back to the Brexit days and was Brexit going to happen or not? Trading, literally just trading off the back of what the latest opinion polls were saying. And if we could end up being in a similar sort of situation with regards to Scottish independence. So one way or another is going to be quite interesting, I think.
Well, let's talk about another one or another. It's economics. What are the economic benefits of not being in the UK? Is this just a political identity, nationalist sentiment thing, or is it dollar? You know what I mean? Nuts and bolts kind of. Pounds and shillings.
It's difficult to say, but let's say as a starting point, I mean, Scotland contributes somewhere between 7.5% to overall UK GDP. So if they were to pull out what happened, well, simply in terms of financial flows, Scotland is a significant net beneficiary of net flows coming out of Westminster. So effectively, the England Parliament gives to Scotland more than it gets back.
So do SNP supporters downplay the economic benefits, or they're voting against their economic benefits?
It kind of comes back to Brexit. Scotland does a lot of trade with the European Union, which is a crucial reason why it wanted to stay in. And one of the problems, which is increasing the chances that we do get a fairly big pro-EU vote, is that the fishing industry in Scotland and the drinks industry are really struggling now to sell into the European market because of what happened with Brexit. So they want to effectively get back in there so they can at least build up that side of the economy. Now, that's not the whole Scottish economy by any means, but there's different views as to how much damage and how much benefit it might actually do for Scotland if they were to pull out. But I think if you look at, in general, I think most of the figures would suggest that, as I see it, Scotland would be slightly worse off. And I think, again, we could spend the whole podcast on this, which we shouldn't do really. But just as a quick reference point of how complicated this is, Nicola Sturgeon has suggested that she wants independence from the UK and she wants to be part of the European Union. However, she expects to be able to use the UK pound as the currency. Now, how on the earth can she use the UK pound as a currency when the UK is no longer part of the EU? So you're talking about a freely floating pound. I mean, it simply doesn't work, because to join the European Union now, and certainly to join the Eurozone, and you have to tie your currency to the euro.
So it's not completely thought out yet.
It is not thought out, but say it's something which normally investors would simply ignore. But this time round, if we were, say, to get this big majority in favour of a second referendum, independence referendum, it could have some far-reaching effects. I mean, bottom line is, if this thing were to go through, it simply ends the United Kingdom as we know it.
It unmakes the United Kingdom. What happens to the Union Jack? You have to.
That's right. And the other worry is, of course, I mean, at the moment, if you look at the opinion polls, well, where else do we go after that? Northern Ireland, would that perhaps then consider just, reuniting with Southern Ireland and leaving the UK? Wales, I mean, would that mean Wales pull out?
It's England and Wales. Well, where's Wales going to go?
Well, Wales at the moment, the polls there are still suggesting that they're firmly in favour of remaining part of the UK. Part, I think, because, they are net beneficiary by somewhere as part of that. But, once it starts unraveling, it's hard to say where it's going to.
That's because you split up your football teams. If you only had a football team, the whole history would be different.
And I think you implied to look at the Eurozone, or the European Union, I should say. One reason why the EU really didn't want the UK to leave the EU, apart from the fact it was the second biggest economy in it, was that, well, if the UK leaves and makes a success of it, then who's going to go next? So it's all this kind of thing. It's starting with a little snowball, and the risk is it comes into a very, very big snowball. All right. What else should I quickly be mentioning since we've probably been talking for a while already? I should mention I spent the last several weeks sort of really talking down the European economy, in part due to the sluggishness of the vaccine rollout. Well, hooray, hooray! The latest figures are actually starting to look a lot more better. I should mention that the Eurozone economy contracted 0.6% on a quarter-on-quarter basis, provisionally anyway, in the first quarter. But the early signs of the second quarter from most of the business and consumer surveys suggest that things could actually look a lot better. And crucially, for this to happen, looking at some of the supplies now that the Eurozone, EU, I should say, are getting from the vaccine producers, and they received just 14 million doses. This is the entire European Union in January. It's only up to 28 million in February. But March now, it looks like they've got about 60 million, and they're expecting 105 million in April once we get the final figures in. There could be as high as 200 million in June. And that is now starting to be reflected in a fairly sharp, well overdue, but a sharp pickup in the vaccination numbers. And that does appear to be starting to impact the economic figures as well. So I think, having had a better than expected, certainly, but still poor first quarter, the second quarter could look a lot better. I could just mention things like the economic sentiment index, which is one of these figures that the ECB looks at quite closely. April, that was up to its best reading since September in 2018, and perhaps just as importantly, it produced its steepest monthly gain ever. And
it was unexpected on the consumer side.
That's right. And again, I think it really does reflect the fact that, hooray, perhaps the vaccine rollout is starting to pick up as it should be. Right. What else should I be mentioning on my side? I don't often talk about it, but I should just quickly mention Switzerland, where some of the numbers there have been remarkably strong. You said on your side about the last set of retail sales being, really strong. Well, we saw March retail sales again. These are volume numbers for Switzerland. They're up 22.6% on the month. And looking at discretionary spending, so we take out, food and drink and tobacco and that sort of thing. Discretionary spending in Switzerland is now 16% above its pre-pandemic.
Did they get stimulus checks too?
They got nothing like as much as your side, but there has been a lot of support for the labour market, and I think there seems to be a lot of confidence out there that things will start turning around. And for anyone who looks at Switzerland, the KOF Institute, they have this leading economic index. Well, that climbed up to 134. And to put that in context, this is for April. 100 is its long-run average. And you saw with it, this is a new record, and it also saw its second steepest ever rise. So it really does, because there's second quarter and perhaps third quarter Swiss GDP is going to shape up very well too.
Well, it's interesting you used the word snowball in a different context, but there is this little element of that we're talking about, perhaps a snowball, the beginning of a snowball in some of this data, U.S., the Swiss data you were just talking of, some of these purchasing managers, even some of these export and import rates are just shooting through the roof right now. So, and will this just be a one-time event, or will the comparisons, even though it's monthly comparisons that count? But in any case, will this stuff slow down? And if it doesn't, then the central banks might have to come in earlier than expected.
Yeah, it's going to be interesting to watch. I'll tell you one thing I think which perhaps folks should be looking at. That's going to be some of these savings rates. Because the general assumption appears to be that there could be some kind of at least mini consumer boom happening over the rest of the year as we finally hopefully get rid of COVID. Well, so long as the savings rates do start coming down, that's going to keep it going. But if people decide they're still uncertain about the future, savings ratios remain historically high, then obviously that's going to limit the amount to which we're going to see the consumption numbers rebound.
And some of the monetary numbers you covered, right? You covered the Bank of England, you recover the ECB. It looks like, is there slowing down in personal loans?
Well, there has been, certainly. I mean, to be honest, one of the reasons why the Eurozone economy contracted in the first quarter has been, the lack of consumption. And again, it obviously comes back down to COVID and the lockdowns and so forth. But it's certainly the case that lending for consumption, private sector consumption, household sector, has been running in at negative rates for a while now. And in fact, one of the last couple of months, we saw one of the steepest declines a multi-year steepest decline. So I think it comes back to when you look at at central banks like the Bank of England, they may be muttering things about a form of tapering because the economy is doing well. People on your side obviously talking about, well, when might the Fed tighten because your economy is doing well. But for Eurozone as a whole, yes, I'm talking up the potential of a second quarter, but the first quarter was still very disappointing. And I think, as you say, the concern there is that there's a lot of hype around, but if it's not actually realised, then what they really don't want to do is to see rates start moving back up before they're ready. And of course, over the last few days, to coincide with this talk about things are looking better in Europe, we've seen some of these bond yields starting to move back up again. The ECB is not going to like that, so I suspect they'll be making that much more use of their pandemic emergency purchase program. They talked about increasing purchases there, which they have certainly been doing of late. Haven't quite got out this week's numbers yet, but I suspect they're going to have to be more active in that, or we could well see, particularly if your yields start moving back up again, unwanted tightening of financing conditions, as they call it, across Europe. Okay, that's a good half an hour already, isn't it? Just when we're having fun. Anything else from your side?
No, I think we're good for now. Until after we'll have the next employment report, U.S., and that'll give us plenty to talk about.
It will. Should be a good one. Oh, I should actually quickly mention Friday US employment report. We'll also get Canadian one as well. Now, I just mention on that because I think we talked before and people are becoming used to very good numbers out of Canada, but this one's expected to show a decline due to some tighter restrictions. We had a big increase in their COVID numbers out there. So it may well be that even though the Bank of Canada is amongst the first of the big banks to actually start tapering, we could perhaps see a second quarter that might disappoint if the employment numbers do come in on the soft side. Okie dokie. Well, in that case, I guess we might as well finish it there for today. So on behalf of Mark and myself, thanks very much for listening as ever. We'll be back next week, but of course, in the interim, you can get all the key market moving data and events in Econoday's global economic calendar. So we'll see you next time. Bye for now.